Hello, this is John Lynch, Chief Investment Strategist for LPL Financial. In today's Street View video, I'd like to put the most recent market rally in context for investors. Now, obviously, it was a very difficult December with the worst December in over 80 years. However, we followed that up with the best January in over 30 years. Now, it's been a very impressive rally, but I do think it's important to recognize that the most recent 10 or 12% gain that we saw in the S&P 500 was the easy part. Because when you're at 2,600, you plunge down to 2,350 so quickly, essentially drop like a rock, we didn't have any time to set up any base camp. Now that we're back up to the 2,700 to 2,750 range on the S&P 500, we are running into more resistance, areas which had previously been support. Now, historically, the market likes to retest. Investors don't like retest, but the market typically retests. Now, it's possible we could avoid a retest of the lows when you look at the causes of the December sell-off. We had the highest hedge fund redemption of the cycle, and we also had a curiously confusing message from the Federal Reserve. So hopefully we won't hit the retest, and we believe that technical tailwinds can be supportive as well as positive fundamentals. But nonetheless, hope is not a strategy, and we want investors to focus on some of the technical tailwinds. First and foremost, 70% of the S&P 500 recently hit a 20-day high. Secondly, over 20 trading days, the S&P was up by more than 10%. When you see those two conditions, historically, forward 12-month returns are approximately 12% for the S&P. Now, finally, the third year of the presidential election cycle also tends to have returns twice average. The S&P typically does 8%. Third year presidential cycle typically does about 16%. I do believe, as we wrote in our 2019 outlook, it's terribly important for investors to focus on the fundamentals. So while we're running into resistance, I want investors to factor in a few things. First and foremost, we have clarity on oil. It certainly appears that oil is now a supply issue as opposed to a demand issue. Second, it looks like we have clarity on the Fed. They won't be as aggressive as investors initially feared. And finally, we need clarity on trade, because we get clarity on trade, businesses start investing again, and to the degree capital expenditures increase, that enhances productivity, which makes workers more productive per output of hour worked. Therefore, that's not a wage inflation threat. That helps profit margins, it helps income statements, and if we're able to achieve those, I believe the market can reach new highs before year end. Thank you very much.